Today, we're diving into a really fascinating company, a real puzzle in the financial world. Aptus Value Housing Finance. We're talking about a lender that pulls in profits that the big household name banks can only dream of. So the question is, how on earth do they do it? And more importantly, what are the risks hiding just beneath the surface? Let's get into it.
So this is the big question, right? This is the core puzzle we're going to unpack today. You have a company that lends money to people like small shopkeepers, vegetable vendors, folks in smaller towns who often don't have formal income slips. And yet their profitability blows the big banks out of the water. How is that even possible? That's what we need to figure out.
All right, just a quick heads up before we really dive in. This is all for educational purposes. It's not financial advice in any way, shape, or form. We're just breaking down the business using information that's already out there for the public.
Okay, let's kick things off with Section 1. We're going to look at the absolute foundation of this company, what makes Aptus, well, Aptus. We're talking about their business model and what analysts like to call their competitive moat.
So here's the secret sauce. Aptus's competitive advantage, its moat, isn't some fancy new technology. Nope. It's built on just being really, really good at the basics. They have this laser focus on a very specific customer, the self-employed person living in a smaller city or town. You know, exactly the kind of customer that the bigger, more traditional banks often just ignore. Now this is where it gets really interesting. Look how they do it. Aptus controls every single step of the process. They don't use outside agents to find customers. They have their own people on the ground. They don't just look at a tax return, they have their own experts who can figure out how much a small business is really making. And when it comes to collecting payments, that's done in-house too. This gives them this incredible control over quality, from start to finish.
Okay, so we've seen the how. Now let's look at the results of that method. And honestly, this is where the Aptus story just gets kind of wild. The numbers are incredible.
First up, let's talk about net interest margin, or NIM. Just think of it as the basic profit a lender makes. It's the difference between the interest they make on loans and the interest they have to pay for their funding. Aptus is consistently over 12%. Just to give you some perspective, most big banks are thrilled if they hit 3 or 4%. So yes, this is exceptionally high.
Next, take a look at their return on assets, or ROA. This basically shows how good they are at using what they have to make money. Aptus is sitting at around 7.5%. The industry average for their competitors, maybe 3.5% to 4%. So they are literally more than twice as efficient as the average player in their field. It's just stunning.
And here's the proof of just how lean their operation is. Their cost-to-income ratio is under 22%. What that means is, for every 100 rupees they bring in, they spend less than 22 on running the business. The industry average for that, it's way up there, around 35 to 40%. This just goes to show you how effective that fully in-house model really is.
And you can see this isn't just a flash in the pan. This table tells a very clear story over 5 years. Look at the trends. Revenue has almost tripled. Net profit is right there with it. And return on equity has been climbing steadily, now over 18%. You're looking at a picture of a really powerful and consistent financial engine at work.
So, at this point, the story sounds almost too good to be true, doesn't it? And whenever you get that feeling, that's your cue to flip the coin and look at the other side. So let's talk about the risks. What could actually go wrong here?
This is the exact question you should be asking yourself. Whenever you see numbers this much better than the competition, your first thought has to be, okay, what am I missing? So let's go looking for the potential cracks in this fortress.
Well, here's the first big one. Take a look at this. Over 70% of their entire business comes from just 2 states, Tamil Nadu and Andhra Pradesh. This is what you call a classic concentration risk. Think about it. If there's a local economic slump or a natural disaster or any problem that's specific to that one region, it could hit Aptus way harder than anyone else.
Next up is asset quality, which we measure by looking at bad loans, or gross non-performing assets. Now at about 1.5%, Aptus is doing pretty well, but you can see a competitor like Avas is actually doing a bit better. And lately that number for Aptus has started to tick up just a little. And remember, their whole business model is built on having pristine asset quality, so any sign that's getting worse is a really big deal. And there are a few other things to keep an eye on. For one, some of their key early investors have been selling off their shares. That creates what's called a stock price overhang. Basically, there's just a constant supply of shares hitting the market, which can keep the price down. Also, the big banks are starting to wake up and smell the profits in this space, so competition is heating up. And finally, Aptus's customers are very sensitive to interest rates. If rates stay high for a long time, it could really put a damper on the demand for new loans.
So you've got these unbelievable profits on one side and some pretty significant risks on the other. How do we figure out which one is more powerful? Well, let's do what analysts do. Let's put this business model through a stress test.
Now, I know this matrix looks a little complicated, but the idea behind it is actually super simple. We're just trying to see how the business holds up when things go wrong. So let's look at a really tough scenario. Imagine their bad loans or credit costs suddenly spike, going from a low 0.25% all the way up to 1.25%. Even if that happens, their return on equity only drops from about 18.6% to 16.6%. And that's the key takeaway here. Their massive profit margins act like a giant shock absorber.
And this quote really sums it all up. Look at that bottom right corner of the table. That's the absolute worst case we can imagine, with high credit costs and slow growth. Even then, Aptus is generating a 16% return on equity. That is still well above its cost of equity, which is basically the minimum return investors expect for taking on the risk. It shows there's this huge safety margin built right into the business model itself.
Okay, so what do you do with all this information? For our final section, let's put together a simple, practical checklist you can use to keep an eye on the company's health yourself.
And let me say it one more time, just to be crystal clear. This is not a recommendation to buy or sell anything. Think of this as a mental toolkit, a framework to help you do your own analysis when new quarterly results come out.
This checklist is basically your dashboard. You just need to focus on these three key numbers. If their bad loans, the GNPAs, start to creep above 2%, then that whole pristine quality argument starts to fall apart. If their collection efficiency dips below 98%, that's a huge warning sign that their customers are under stress. And if their growth slows down to less than 10%, well, it stops being seen as a high-growth company. These are the numbers that will tell you if the Aptus story is holding up or starting to crack.
So in the end, we're right back where we started, with a classic investment puzzle. On one hand, you have some of the best profitability metrics you will find anywhere in the financial industry. On the other hand, you have very real, very concentrated risks. The question for any investor is this: which one of these powerful forces, the incredible profit engine or the heavy geographic risk, is ultimately going to win out and define this company's future? That's the question to keep in your back pocket.